Stocks did not finish the week as strong as we had a really good week for the most part. Had a good bounce last Friday. It started off a little soft on Monday, which is normal, especially after a big move like Fridays. And then Tuesday, Wednesday, Thursday looking great. Today, not so much. So on one hand, I'll show you some indicators that would suggest that it's not that bearish, and actually the move off the lows is really helpful. I'll show you how and why. Today, like just a little bit coming off the lows is so helpful from a technical perspective, but it also sets us up for Tuesday and Wednesday for some potential for weakness. So, and I'm going to break down kind of what the red flags that are showing up, especially on a long-term basis. Some of the long-term charts are really showing that how close we are to kind of rolling over. Again, nothing dramatic. We're not going to have a big sell-off. We're not going to go bearish. But rolling over to a nice easy 5% decline is no big deal. So I'm going to show you what those red flags are. There's a lot of it has to do with rotation in the sectors. Intermarket relationships as well play a key factor in that. So I'm going to break all that down. And then our trade idea is actually on a really important bellwether for the markets that also kind of gave us a red flag today. We're actually going to trade that red flag. And I'll talk about what it means for the whole market and then how to trade that. So let's go ahead and get started. Today is Friday, August 29th, 2025. This is the market outlook from marketscholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel, this Market Scholars icon here with the red subscribe button down below. Click the thumbs up icon to like our video today. Comment on anything that stood out to you. Share the video with anybody else. Join us at marketscholars.com. There's a link up there. You can subscribe to our basic service to get access to our market outlook blog posts. One stop, catch up on the market, see what happened today, see what matters, see what we need to watch for going forward. You can get that for free at marketscholars.com with our basic subscription. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're on our website really quickly and you want to get to our Market Outlook blog posts, just come up here to go to marketscholars.com. You can see all of our pricing comparison for our different tiers. As I mentioned before, here we can just go to here. The basic gets you free access to our daily Market Outlook recaps, the blog posts. Again, one-stop shop, know exactly what happened today, why it matters, what to watch for. The foundation tier gets you access to the videos and the Market Outlook live posts, as well as the trade tracker, as well as everything else in the basic too. You get that for just $29 a month, or 2 months for free if you do the $299. So that's all there. You can also get access to our Market Outlook blog posts. Brings up this page here. Again, to get to the free subscription, to get the blog post, it's right here at the very top. Subscribe now for the preview. Just click subscribe for free, and that takes you to the subscribe page right here. Just join for free. Get everything you need. You get those access to that. Then once you do that, see if you don't have that, it'll ask you to join free as well when you click on the blog post. And then there's a link for our foundation. And if you're already logged in, if you're already a member, if you already have it free, you can just log in down here at the bottom and get to that. So once you do that, here, just logged in here. Once you log in to it, then you get access, like I said, to the whole preview, the preview video, and the recap here that tells you again everything that happened today, what matters the most, what to watch for coming up, what it means, and some final thoughts. And then again, you can get access to our foundation tier with any of these links here or right there as well. So that's every day. That's for free. That's for free every day, as well as the free version of the Market Outlook, which is about a 5-minute version. The full 30-minute version is on the same page. If you're a foundation member, if you're any of our subscribers, it's actually on the same page. You'll just see the full version here instead of the preview version. All right, let's start off taking a look at the S&P 500 with the market forecast indicators. You can see we were down today, closing below yesterday's low point. So yesterday being the high day of this, at least the near-term rally, but also in pretty much every rally, the intermediate rally, the market sentiment rally, and closing below the proverbial low, below the actually literal low of the high day. It can be considered a sign of weakness. people look at that kind of thing, look closing above the high of the low day. It's kind of another factor, and it did. You can see we were well off the lows. At one point in time, we were down 0.8%. And when we were at the lows, here, let me kind of show you what it looked like when we were actually at the lows of the day today, 644.57. So when we were at the lows, the momentum line was extremely low. The near-term line had crossed 60 and 50. Like, things were not looking good. In fact, I mean, the momentum line was literally at 0 when we were at the lows of the day today. So let me remove that, come back to normal. But because we rallied, the momentum line ended up rising. Again, it is below 20, and the near-term line is below 60, but just barely on both those instances. So not nearly as bad as it could have been without the bounce off the lows towards the end of the day. We are still a percentage point up above the 30-day moving average, but and technically, again, by definition, this is a bullish intermediate confirmation signal, an oversold momentum line. We bounce off of that with a strong bullish posture. It's a buy the dip signal. Now, it is barely below 20. The near-term line is barely below 60. So it's not even in the lower half of the chart. So my guess is more than likely we'll have some weakness. Those both might continue to go lower. Now, whether or not, maybe it's just a small range in the market. I don't know if it's another down day on Tuesday. But my guess is both those lines will probably go a little bit lower before they bounce back up to the upside. And in which case, that might occur early next week. Remember, Monday's market's not open, so it won't happen on that. So so it ended up being a pretty good day by the end of the day today, despite the decline, like 0.2%. The NASDAQ 100 was down a little bit more. You'll see why in a second. But down more than 1%, about 1.25%. As a result, the intermediate line's already below 80. Never did get back above like the S&P, and so it's we have light pink shading now, and we don't quite have the close below the moving average. We're 0.06 of a percentage point up above the moving average, so that's how close we were. Again, at the lows of the day today. So if I were to put the close here at the lows, then apply there. I don't know why. Sometimes it doesn't let me apply that. I don't know why. Yeah, so for some odd reason, it doesn't let me do correct the bars on the NASDAQ like it does on the S&P. But at the lows of the day, we were below the moving average, and we did have another bull tag. But we avoided it because we closed this, again, 0.06 of a percentage point above the moving average down there at the bottom. But, again, the intermediate line remains below the market sentiment. That's a bearish pattern when the intermediate line is below market sentiment. Also, your near-term line is crossed below the intermediate line. That's a bearish cross. So again, and we do have an oversold momentum line. This is not a bullish intermediate confirmation signal because we don't have the strong bullish posture on the S&P. So something to keep in mind there. Looking at the Dow Jones Industrial Average, you can see strong bullish posture. Market sentiment's rising above 80, barely, but rising above 80. The near-term line is in bullish territory still, despite its decline, and your momentum line is, also dropped with a little bit of a decline today, only 0.2%. And it's in bearish territory, but not oversold. So nothing too significant there, but also suggestive of, that we could have more of a decline and actually still not even be like oversold if that were the case. And then finally, let's look at the Russell 2000. Again, it was down as well, 0.5%. So outpacing the Q significantly today again. The near-term line down, the intermediate line strongly bullish, so we don't have to worry about that. Oversold momentum line, so bullish intermediate confirmation signal. Again, the near-term line still in bullish territory, so if we do get a bounce, it won't be a big one. But it's possible and very likely that we'll actually probably get another day to the downside to bring the near-term line lower, and then at that point there's a good chance that we bounce up. So depending upon, again, in the after hours, the news came out that the tariffs were ruled illegal by an appeals court. So I don't know what impact that's going to have on the market at the open. We'll find out, I guess, when the futures open. But after the weekend, and we do have the holiday, if you recall. So we'll see kind of impact that might have. And obviously it's going to be appealed. And so I'm not really sure how big of a um, appeal to the Supreme Court. I was obviously probably not going to have that big of an impact as the tariffs still remain in force. And so I don't know how much of an impact it will actually move markets. We'll see by the time we get to next week. Let's go back to the S&P. Let's take a look at the weekly market forecast since it is the end of the week. And you'll notice, again, we have strong bullish posture on the weekly chart. Near-term lines in bullish territory. Momentum lines neutral. Very small range. If you look at this week's range, there's only 79 points on the S&P 500. So very, very small range there. And then finally, since it's also the end of the month, let's take a look at the monthly chart. And same thing, strong bullish posture. Near-term line strongly bullish. Momentum line is low, oversold, in bearish territory, but not oversold. We are way up above the moving average, 23%, which is not very, it's high, but it's not extreme, the 75th percentile. So we've had 4 months in a row to the upside. It's a pretty good rally that we've had. In fact, if I were to go to this chart here and then go out to change this to 4. So this is the last 4 periods, and we'll change this to SPX, and we'll come out here to maximum. So we have the last 4 months have been a 16% rally, and that's not too crazy. If you notice, if I were to activate this drawing, it's at 20%. We're below 20% on a 4-month basis, so that's not too bad, despite the fact that we had a pretty significant gap down on the first day of the month. We still, and we can remember August 1st was such a down day. One of your bigger down gaps on the first day of the month that we've seen. We finished the month significantly higher. And, last time we gapped down more than a standard deviation. We also finished the month higher. And you can see these two, and with COVID, we did not. March 1st, or excuse me, this would be April 1st and May 1st, we gapped down, and we finished down on both of those. And then finally, this last one here, we also finished lower on that gap down on the first day of the year in 2019. But then you can see, rallies, big, strong rallies, again, over 4 months period to the upside. So it's been a good little stretch, and we have strong postures, and the weekly chart here is still looking good. We had a higher high, we have a higher Hakunashi close. With the pullback, however, we did close below the Hakunashi close, so at 64.60 instead of 64.63. So we are set up for next week to be a transition candle. So only a 4-day week, remember, and it's post-holiday, but it is September, and September tends to pick up the volatility as school's back in session for the most part, and everybody's back to work, and vacations are over. So it's something to keep an eye on next week. Remember, transition candles can be reversal candles if they are also bearish, and a lot of times if you also get that red arrow with them. And we're probably not going to get the red arrow next week, no matter what the transition candle looks like. But we do need to be aware of the possibility of the transition, and the possibility of that transition being bearish because of how we close, right? Because of the close below the Hakunashi close here. Again, finally, one more look on a weekly basis. We like to look at the whole weekly chart. And again, we are very close now. So next week, the parabolic SAR is going to get even higher, and we're going to be very close to flipping it. And we tend to flip it during these kind of transition bearish candles. You can kind of see, and if and when we flip it, and the line turns red, then that usually signals at least intermediate decline. At the very least, intermediate decline. As we can see, pretty much every intermediate decline starts that way. So, and you can see the PPO here is close to crossing over. Usually the PPO is below the moving average when you get these intermediate declines as well. So we are close. We are a lot closer now than we were a few weeks ago when I said we're not close. So now we are getting a lot closer to flipping things around, and again, like I said, starting an intermediate decline to the downside with a negative, with a bearish candle. That we haven't had a bearish candle, even though we're below the average. We haven't had a bearish candle here for a long time, since the week of April the 8th, the low point. All right, let's take a look now at the 3 green arrow chart. So not surprising, we have 3 green arrows all across the board except for the Qs. The Qs have 2 red arrows. So the MACD is turned back red and never did turn green. So we never did get the 3 greens, and the stochastics is turned down. So that's kind of a little interesting setup we have there. Let's take a look at the weekly charts as well. Since this is a weekly, it's like I said, it is a Friday. You can see you have 3 green arrows all across the board on those charts too. However, the MACD you can see is close. We're close to getting a red arrow on the MACD on both the S&P and the NASDAQ. Not as close to getting that green arrow on the diamond or IWM. Let's take a look at the 2-line version of this chart. Again, strong. We flirted with closing below the 8-day. We did not, but that does open up the possibility. So we talked about today quite a bit about crossing multiple moving averages. Because we did not close below the 8-day, we create the possibility of closing below the 8 and the 17 Tuesday. And it's closing below multiple moving averages, whether it's the 8 and 17, whether it's the 17 and the 30, but crossing multiple, that's when we're concerned. So, for an example, as you'll see with our trade idea the other day, NVIDIA closed below all 3 of those lines today. That's where we start to really worry about a weakness. So we don't quite have that yet on the daily chart. And of course, the weekly chart's looking really good, right? We're well above the 8-week moving average. Again, the MACD histogram is coming down. We saw that on the 3 green arrow chart. And the MACD itself is really, really high. It's in the 85th percentile for the past 3 years. And the average itself, both lines are above 2 on this long-term PPO, and that's pretty strong. The momentum is strong and appearing to start to wane right now. Let's take a look at some of these other oscillators. We'll take a look at the DMI. Still a bullish pattern, even though it's the negative indicators crossed back above 20, so that's kept the ADX below 20. The positive indicator is down, but at least it's still above 25. We take a look at the RSI and the CCI. They're still, again, they're bullish. They're not as strongly bullish because you're back below 60 on the RSI, but you're not below 50 yet, and you're below 100 on the CCI, but at least you're not below 0 yet, or especially below minus 100 is when we start to get worried. So both of those lines are looking just fine, and no concerns or issues there as of right now. If I take a look at the Ichimoku cloud, we still have our strong trend, and we're still above the green line. So again, we don't really have to worry about breaking this trend, which, when it's so mature like this, when it breaks, we usually go to intermediate decline. But, we don't have that concern yet because, we haven't broken the blue. You usually have to break that blue line to break the trend. And we're not there. And rate of change still positive. We're still above the cloud. The cloud's still green. Like everything's still very positive there. And then finally, looking at the Bollinger Bands, the bandwidth is coming back down. It has been rising, but it came back down today. The bands are moving in towards each other as the momentum dropped down. We're not in the lower half of the bandwidth, so that's not an issue yet. But we are outside the upper quartile now, and you can see the momentum has dropped here. As again, like I said, the bands are moving and are really close to moving back inside of the Keltner channels there. Let's take a look at today's intraday move. So we pull that up here. We did get a common gap, so we did not fill it. So there's a good chance we do fill that. So that's a good thing for the markets. We closed right at the point of control. There is not very much support below it, so we're very high centered. As long as we can hold this and get above the highs, then great. You have great support below us. But here we're sitting at the point of control, and there's a very weak margin of safety because there's nothing below us to hold us up. We can move down pretty quickly, as we moved up to this level pretty quickly off of that move in Friday, and we dropped pretty quickly there as well the previous Tuesday and Wednesday. So we can fall here and falter down into the lower half of this chart pretty quickly. But again, it's not a threat. It's not imminent. We are out below the upper. We are below the outside the upper reversal zone, just barely below 80, and the moving average actually is slightly above 80. So we're slightly below 80. We're slightly below the moving average, but again, slightly. We'd have to really build on that on we have to build on that on Tuesday if we're going to really be weak. You can see the size of the the low points moving up here, and it's going to move up again on well, a little bit more on. So this is today. So this would be Tuesday, Wednesday, Thursday, and then Friday. By Friday, if we don't get a new low by Friday, you're going to get another jump on the red line up above 30, and then we'll see. Like last three have been okay. But we'll get another jump there, and the size of the, if we don't get strong new highs, we're going to go from 619 here to 633, a 14-point move. So we're really going to condense this range if we don't get a new, 14-point move to the upside to offset that over the course of this next week. So again, we can be pretty bullish this week, but we can also have a pretty bearish pattern by Friday. I mean, we could be flirting with the lows, and it would be the 4-week lows by the end of the week. We might have a new 4-week low by the end of the week, because again, it will be right here. So that's the idea. Like we're a lot closer to a period of weakness now than, like I said, the past few weeks I've been like, oh, we still got some time, and we're not close, and now we are getting a lot closer. A lot of not necessarily red flags, but definitely some yellow flags that are suggesting, we're not as bullish as we have been. If I take a look at today's range and volume above average on the volume, slightly below average on the range, it was a pretty decent range, but not enough to get back up. Well, I guess we did barely get back above 0.8. We were below 0.8 for most of the day today. So looks like by the end of the day, with the move to the lows, we expanded the range and got up above 0.8. That's an extreme. You can see the volume is still elevated. The money flow is still a red flag here, because again, we got new highs yesterday, and the money flow is much lower, and we're already below 50 on the money flow index. So that's a little bit of a red flag going on right now with the markets that we need to pay attention to. Finally, your VIX finished the day higher. We were above 15 today. Did not get above 85. So we're kind of still in the sweet spot from a volatility standpoint. And your VVIX jumped up to 97. So not above 100. So we're not as concerned here. If it were to get above 100, now we got something to worry about. But if you take a look at the VVIX relative to its own average values over the past so many periods, we are now up above multiple average, 50-day average, 30-day average, 17-day, not quite the 200 yet. That's when you start to worry, especially if it's above 100. Like the 200-day is still above 100. So that's when you start to worry, and we're not quite there yet. But again, a relatively bullish day today on the VVIX, and when you get these crosses or these averages, it tends to lead to a little bit higher move in the VVIX. And of course, with the VVIX being as highly correlated with the VIX as it is, back to 86%, a jump in the VVIX would usually correspond to a jump in the VIX as well. All right, now let's talk about what's driving a lot of this price action. So let's go out here to the asset class comparison chart, and let's take a look at today first, and then we'll zoom out to the week that was. Here, zoom into just today. Gold being up today, the dollar flat, commodities outperforming. They weren't up a lot, but they were outperforming equities. Equities were all down today. Yields were higher. The Qs were down 1%. IWM was down, but only 0.5%. So that's probably the biggest thing that happened today after a little bit of a move lower previously on yields. That's why we were so bullish the last few days, especially on the 10-year yield. Remember, we got that cluster on the 10-year yield jumping up 2 basis points today. You can see the MACD and stochastics potentially forming higher lows with maybe equal lows there. And as I mentioned before, we had the cluster on the 10-year yield yesterday, and whoops, sorry, it's not it. Try that again. So the cluster yesterday, and you can see, I mean, we're still oversold. The momentum line's in bearish territory, not oversold anymore, and the near-term line is, but a little bit of a bounce higher, and intermediate line slightly in the reversal zone. So we'll see what ends up happening here going into next week with those yields rising today. Again, it's only one day, and we've, for most of the week, it was actually down. If you take a look, if I now zoom out here to the rest of the week, You can see, gold ended up the week really strong, despite some strength in the dollar. Gold really ended up the week strong, pushing out to higher close. Obviously, not a higher intraday high like we had a couple weeks ago before expiration, but a higher closing high. So we're continuing to push higher. The intermediate line is back in bullish territory. It's crossing above market sentiment. The near-term line strongly bullish there, without the momentum line, but still strongly bullish. So we're clearly like on a new intermediate run. Like we had a quasi-intermediate pullback. We didn't get dark pink shading in the red line, more of a kind of bull tag type pattern, but enough to get the intermediate line went into bearish territory. And now dark green shading the green line and really taken off. And you look at the 2-line version of this chart on the MACD and stochastics, again, such a big volume node here and kind of an ascending triangle with these equal highs that we've had over the past so many months and kind of gradually higher lows, but we've been converging and then now, breaking out. So, but if, again, 1 week does not make a breakout. So we have to, see if that ends up being a fake out pattern, because that happens quite a bit. The MACD itself is already pretty high, relatively speaking, not as high as it has been here recently, but it's, before that it's pretty high. And, the gap between the 50 and 200 week moving averages, again, is about as high as it's ever been, right? When I look at the 50, 200 day here, apply that, and now let's zoom out. Let's just go as far as we can go back. Again, it's about as high as it's ever been, right? They got this high after the credit crisis on that MACD. It's also got this high during the worst of the so the credit crisis here in 2011. So right after, it kept going up after the credit crisis, but we had already peaked there. And the same thing, we peaked during the correction phase of the failed correction bounce and moved lower. But in that correction stages, we peaked there in gold. The moving average kept going up. The gap between the moving averages kept going up. And that's kind of what we're seeing right now. That's a really, really high level. And again, if I take off those lines, we can just look at the histogram on that and see, that's, that's a pretty strong peak on the MACD. We've got some bearish momentum, but still very, very strong move higher, again, on a weekly chart. So for example, if I were to take a look at the DMI here, and let's look at the ETF. There's the daily ETF, big breakout pattern there on the daily, coming out from below 10 on the ADX. But if I were to go out further, we've been very parabolic on the weekly chart, very, very parabolic. So, and of course, if I were to zoom out even more, we are insanely parabolic on the monthly chart. So let's just go out all the way that we can, and let's switch this. Let's see what this looks like. Yeah, you can see very parabolic on the monthly chart. Now you can see, from 2001 all the way up to 2011, gold was strongly bullish there. We had broken it. We had been really bearish going into 2000, then it just took off during after the tech bubble and going into the credit crisis, and then we kind of had a little bit of a cup and handle type pattern, and we're breaking out there. So there's been times where we've gone this parabolic. Look at the negative indicators, as low as it's ever been here. So again, that doesn't mean it can't keep going up. It just means that we have to be aware of just how strongly bullish it is, and not necessarily, because again, weakness in gold, if it were to peak, because usually parabolic peaks don't just stop, right? They tend to reverse, and if that's the case, and at some point in time gold peaks, then that's going to most likely coincide with the dollar rallying off of its lows. And right now, it's had some significant lows. You can see how weak this weekly chart is looking. It's coming off of those. The monthly chart for the dollar has been pretty bearish. The MACD is on the 817 is about as low as it's been. So are we basing here? And if we do, and we move back higher, then that would coincide with weakness in gold, and obviously it would coincide with risk aversion more so than risk appetite than what we typically would expect. So gold and yields are really important. The trend of gold, great, ride it. as long as we can. But if and when that parabolic move ends, and then yields, if they go up higher like they did last time we had rate cuts, especially considering that the 10-year yield is not below the Fed funds range right now, like it was the last two times we had these mid-cycle adjustments, then there's both those, a rising dollar and rising yields, have both been weak, have both provided weakness for the stock market. So we have to be very, very aware of those two elements. The breadth today was not great. It wasn't bad. It wasn't negative, but still not strongly positive, which is actually probably not a bad thing, because if it was strongly positive, then it usually coincides with the end of a mature intermediate run. So it's positive. So we're avoiding Hindenburg omens. We're not getting any new lows. So I don't think we have too much to worry about from a Hindenburg omen standpoint in terms of how close we are to the end of a correction move, right? How close we are to a new correction. And we are still only 4 months away from the last one. So it's highly unlikely we'll get another correction. But you see the new lows is way below its average at 7. And the new highs is still relatively high. Like we're still, above 100, still above the average still rising. So we still have pretty decent breadth. We're still well above 300 on the number of stocks above the 50-day moving average, still well above 300 on number of stocks above the 200-day moving average. The net new highs and lows on the New York Stock Exchange and NASDAQ Composite are still above 100, still above its average. So that's still looking positive. So breadth actually still looks pretty good. And it's not so strong that it would suggest, like I said, here in July of last year, we got such strong breadth that when we had already had a mature run, that it pretty much signaled the end of that run. So we don't have that. Fortunately, we don't have that. So I think breadth is looking pretty positive. And then if I look at the sector moves here this week, this is where another red flag comes in that I'm a little concerned about, and that will lead into our trade idea afterwards. If you take a look at just today alone first, then we have a really significant drop in XLY and XLK. Those are the sectors we do not want to see drop. And everything, we had a bunch of sectors positive, but these are all, aside for XLC, all these sectors, their ratio charts with the S&P are all negatively correlated with the S&P. So we don't want them to outperform the markets. They did today. That wasn't necessarily the case for most of the week, as technology was really doing well. But you can see now, look at that change in XLK versus XLE. That's a ratio we do not want to see breaking down, and it's kind of broke down this week. It broke below the 50-day average. It's really moving in between. You can see the PPO is negative, the long-term PPO is rolling over. It's got a 78% correlation with the markets. And the other, XLK, that's the warning sign. You can see XLE is looking positive, and that's great. And you can see the ratio chart with the S&P is breaking above its average. Its relative rotation has both lines above 100. So in what would that category be called again? The leading category. But on the other hand, so it's fine, but on the other hand, technology is breaking below its 17-day moving average. The ratio chart is below its 50-day moving average, and both of its lines are below 100, which means XLK is in the lagging category, which is not good. So we've been rotating out, into an area of the market we don't really want to be in, and rotating out of an area of the market that we do want to be in. And so it was doing okay for most of the week until today, right? Today is the big drop. You still have staples and utilities suffering, interest rate sensitive areas. They would continue to suffer, but yeah, to have energy doing so well and to have technology not, along with communication services and discretionary, that's a little bit of and with XLK underperforming as much as it has been, that's a little bit of a red flag that we have right now. That brings us to our trade idea of the day, and I want to take a look at the biggest bellwether in the market right now. Is the biggest, technology, as important as it is, the biggest sector in technology, and that's the biggest stock in technology is NVIDIA. And NVIDIA had a pretty down day today, down 3%. This is not, again, not that big of a deal for NVIDIA. NVIDIA is a pretty volatile stock. So when you look at, a 3% loss, Like we've had plenty of 3% losses during this bullish run. So that's not in and of itself the issue. I mean, the last one we had here was August 19th. We were down 3.5% on August 19th. So if I were to go back to the market forecast for NVIDIA, so there's August 19th right there. We did not close below the moving average. We had an oversold momentum line. It was extreme. The near-term line had dropped down, but was above 60. We got a bull tag the next day on the 20th, but a long overshadow. Today we did get the bull tag on the 3% drop. So all these other 3% drops, no big deal. But today's is the first one that has a bull tag associated with it. You are 2% below the moving average, which isn't a lot for NVIDIA, as you can see over on the left. But, you know, again, some of these other bull tags that bounced weren't so far below. So if I were to go out 5 years to find like a bull tag, here's a bull tag that bounced instead of reversing. We were down 1% below the moving average on that bull tag. Let's see if I can find any others here. There's a few over here. We were down 4%, so that wasn't so bad. Over here, down less than 0.015%, and this one we were down 1.67. So 2% is not a lot for NVIDIA, but it's a pretty decent amount. It's enough to make that bull tag a little we'd have to have a pretty strong move on Monday to rebound to get back to the green arrows. All right, you can see the near-term line crossed below the intermediate line. The intermediate line still below market sentiment, just like the NASDAQ 100. It had gotten closer to getting above 80 than the NASDAQ 100 did, but it turned lower, so you have light pink shading. We do not have a bullish intermediate confirmation signal because we do not have a strong bullish intermediate posture. And, your momentum line's oversold but not extreme. Your near-term line's in bearish territory but not oversold. So it's okay if that, and this would actually be a great signal if the intermediate line wasn't falling. And then you look at like the weekly chart for NVIDIA, and it's showing a transition candle, right? Multiple transition candles here. We don't have the red arrow yet, so that's one positive that we have. Looking at the 3 green arrow charts, we obviously have 3 red arrows today. It's the second time here recently that we've had 3 red arrows. Obviously do not have a red line yet. Excuse me. But the line's moving a lot slower to the upside, so it's a little easier to turn red. If I were to take a look at the 2-line version of that chart, you can see again we broke below multiple lines like I showed you before. There's not very much support below us down to the top of the value area in terms of volume support because we've just moved up so quickly here. So you can, the MACD has been converging forever. It's close to crossing below 0. Stochastics looks like it might be forming. We had above average volume for the last few days that have all been red. The DMI, let's take a look at the DMI. It's showing a bearish pattern up above 25 on the negative indicator, crossing above the ADX. The positive indicator easily below 20, so you have a bearish pattern there. You look at the RSI and the CCI, and you can see below 50, not below 40 yet, but below 50, which is significant for NVIDIA, and back below 0 after forming bearish peaks on both of those oscillators. The Ichimoku cloud, we lost the trend. We are so very mature in the trend, we lost it. We are below the blue line now. We're close to a negative rate of change, close to crossing there. And then finally, from an from a Bollinger Band standpoint, we are not below any of the bands or the Keltner channels, but we are below the midpoint in between, and we are in the lowest quartile of the bandwidth, with the bandwidth forming the squeeze pattern, right, getting to new 150-day lows and our momentum turning negative. So there's an opportunity here. Again, if we are going to turn bearish on the S&P 500, there's a good chance that NVIDIA leads the way lower. And a lot of times, NVIDIA might go lower first before the S&P. So there might be a little bit of a divergence there. As correlated right now as they are, they're like in the high 80% correlation with the S&P. There's been times where NVIDIA has softened first and the S&P followed after. So even if that's the case, that would present some opportunity for weakness in NVIDIA between now and expiration. So what I decided to do was sell that low 20 delta. Very low risk, low probability trade. It is a low probability trade, but it is a low risk trade as a result. 4-to-1 reward to risk ratio, so it's very speculative. It's got to move pretty quick. The maximum gain is in range. but there's not a whole lot of flexibility there, so it's got to move pretty quick. And again, if it works out, great. If it doesn't, then if it works out, it's kind of like a little bit of a hedge for a 5% pullback on the markets, because this would probably start that. If it doesn't work out, then that means the markets are still bullish and we're still good on a lot of our other bullish trades that we have on. So kind of a little bit of a hedge trade on the market bellwether right now. Very low risk, low probability trade, and that has a good payout if it plays out into even just a modest pullback for the stock over the next 3 weeks. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Scroll to the bottom of the blog post, comment on anything that stood out to you today in the video, or any questions you have about what I brought up, or maybe you have some questions about something I didn't bring up, or a chart you wanted me to take a look at. And let's keep this conversation going over the weekend. Remember, there's no market outlook on Monday. Remember, this is also our free version, so if you want this full version throughout the rest of the week, along with the trade idea and the market outlook live and the trade tracker and all of that comes with it, you can join our foundation tier at just $29 a month and get access to that. It's like less than $1.40 per video, so it's a really good value, especially considering, again, the trade tracker that tracks the results of all these trades that we've done over the course of the year. Way more than makes up for the cost of the access to those videos. So check us out with a link down in the description below. Have a great Labor Day weekend, everybody, and we'll see you all on Tuesday.